Welcome back to Investing Talk Podcast.
Today we're looking at the plant-based meat company. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Right. So looking at the sources on this one, the first thing that really hits you is just a wild ride this stock has been on. It's like a tale of two completely different markets, isn't it?
Absolutely. You saw it plummet, down to a historic low, 50 cents.
Unbelievable.
And then seemingly out of nowhere, it just rockets back up over 1,000%.
With no major news, right? Like no fundamental shift announced.
Exactly. And that's the crucial part. Looking at the chart alone, you'd think they'd found a cure for something major, not just, restructured some debt.
So what was the driver then, if not fundamentals?
Well, it was really a technical tsunami, as some called it. The stock had incredibly high short interest, lots of bets against it. Then came the news that 97% of the bondholders approved that convertible debt exchange. That deal massively reduced the immediate bankruptcy risk.
Okay. So the debt deal wasn't good news per se, but it removed the worst possible outcome.
Precisely. And that acted as the spark. All those short sellers, they suddenly needed to cover their positions fast.
Forced buying, right. The classic short squeeze.
Exactly. A feedback loop. They have to buy back the stock, pushing the price up, which forces more shorts to cover and so on. It was pure speculation meets high leverage, nothing to do with selling more burgers.
That disconnect is key then. This crazy price action versus, what the analysts actually think. How do we square that?
You probably don't square it easily. You have this momentum-driven price, maybe even some meme stock flavor to it.
Right.
And then you look at the professional consensus. It's overwhelmingly negative, a solid sell rating across the board.
And that price target?
Yeah, the average target is down around $2.08, which, depending on the day's volatility, implies, potentially significant downside from where it's been trading recently.
So a huge warning sign there. You might be buying into the hype, not the actual business health.
That's the risk, definitely. Technical momentum completely detached from the underlying financials.
Okay, let's try and ground ourselves then. Forget the trading noise for a second. What are the actual numbers telling us? We've got preliminary Q3 2025 figures.
Yeah, and they confirm the ongoing challenges. The core issues persist, weak demand across the whole plant-based sector, and really tough pricing pressure.
So revenue.
Preliminary Q3 net revenue looks like it'll be around $70 million.
Which is down again.
Yes, it's still showing that year-over-year decline. And maybe more importantly, the forecast for the full year for 2025 suggests revenue will drop about 12% compared to 2024.
Ouch. Down to like $287 million from roughly $327 million last year.
That's the projection. So this is definitely not a growth story right now. It's more about managing the decline, trying to find a bottom.
And profitability must be under immense pressure with falling revenue. What about margins?
Yeah, that's maybe the most concerning part for their long-term viability. Gross margin is projected at only 10 to 11% for Q3.
10% for what's meant to be a premium, innovative product.
Exactly. It's alarmingly low. Successful CPG companies aim for, 30%, maybe more.
Well, what does that signal? High costs? Desperate discounting?
Probably a bit of both. High input costs haven't helped the sector. Manufacturing might be inefficient, but mostly it suggests they're having to slash prices just to move product.
Which makes getting to positive earnings per share incredibly difficult if you're only making 10 cents on the dollar before overheads.
Right. The EPS projection for 2025 is still deeply negative, around minus $1.96 per share.
Okay, so still losing a lot of money per share.
Yes. Now, technically, that's an improvement from the year before, which likely reflects some aggressive cost-cutting they've been doing.
Small comfort, I guess.
Well, it shows they're trying to stop the bleeding, but they're still burning through cash. The big question is, can they stabilize revenue and fix margins before that balance sheet breathing room runs out?
And there was another red flag in the prelims, right? Something about an impairment charge.
Yeah, a material non-cash impairment charge for Q3, asset write-downs.
So what does that actually mean for the business? Like in simple terms?
It means the company's admitting that some of its past investments, maybe factories, equipment, maybe even some technology, aren't going to generate the returns they expected.
Because the demand isn't there.
Exactly. They're acknowledging those assets are worth less now than they thought. It's basically accounting catching up with a strategy that hasn't fully panned out, a sign of real operational stress.
Okay, wow. That paints a pretty bearish fundamental picture. falling revenue, collapsing margins, writing down
And
assets.
fundamentally, yes, it's tough.
But they did pull off that debt deal. That was huge,
Yeah.
right? Avoiding bankruptcy. Let's talk about the turnaround efforts. How significant was that balance sheet fix?
Oh, it was absolutely critical. That's the one massive positive step. They essentially defused a ticking debt bomb.
How much did they cut?
They brought total debt down from about $1.15 billion to around $250 million. That was done through the early settlement of those convertible notes.
So they traded near-term death for, well, longer-term survival.
Precisely. They swapped immediate insolvency risk for a chance to fix the core business.
But isn't there a catch? That kind of debt deal usually involves massive dilution for existing shareholders, right? Issuing tons of new shares.
That's the definite downside. Survival came at the cost of significant equity dilution. You're absolutely right.
So even if they do eventually become profitable, the earnings per share will be spread much thinner.
Correct. The value of future profits per share is diluted, but, the alternative was likely bankruptcy. Short term, the benefit is clear. Their liquidity is much stronger. That current ratio, 3.29, that's very healthy. It means they have over $3 in current assets for every dollar of current liabilities. They've bought themselves vital time.
Okay, time is one thing. Using it effectively is another. They need to fix sales. What's the strategy on the product side? It seems a bit mixed. Premium innovation versus simpler stuff.
It does look like they're trying a couple of things at once, sort of hedging their bets. On one hand, you have the push for real innovation, that mycelium whole-cut steak everyone's waiting for, the limited drops from the Beyond Test kitchen.
Right, the high-end techie stuff.
Yeah.
Emphasizing GMO-free, cholesterol-free.
Exactly. That appeals to a certain, maybe premium consumer. But then you also see them launching simpler products, like that 4-ingredient ground meat.
And pushing into mass retail, like the big 6-pack burger deal at Walmart.
Yeah. So they're expanding at high-end places like Erewhon and simultaneously going for volume with simpler, potentially lower-cost items in mass channels.
Does that signal strategic confusion? Or just pragmatism?
I'd lean towards pragmatism born out of, well, maybe desperation. The premium innovation market slowed down. They couldn't just rely on that.
So, pivot to volume.
Pivot to volume and keep innovating, hoping one path really takes off. The risk, though, as they simplify and chase volume, is they lose what made them unique, their moat.
They become just another competitor in a crowded, price-sensitive space.
Exactly. Competing with store brands, other alternatives. It gets much harder to maintain premium pricing or margins when your product isn't perceived as significantly different or better.
So it's a high-wire act, bet on the next big thing like mycelium, while trying to survive on potentially low-margin volume today.
That seems to be the strategy. If that mycelium steak or something similar truly cracks the code on taste and texture for the mass market, that could be a game changer.
A big if.
A very big if. In the meantime, they're fighting for shelf space and sales in a tough environment, as their revenue figures show.
Okay, looking ahead then, for anyone watching this stock, trading it, holding it, what are the key things to watch, the catalysts and risks?
Well, the immediate catalyst is definitely the full Q3 2025 earnings report, expected late October, early November.
Even though we have the preliminary numbers.
Yeah, because the market will react to the final details, the exact cash burn rate, any updates on cost savings, and crucially, management's outlook and commentary. That call will likely drive the next wave of volatility.
Makes sense. And the big picture risks that are still out there, even post-debt deal.
Profitability is still the elephant in the room. The whole business model still feels unproven at scale in this current market. Can they ever make money consistently without another huge boom in consumer demand for plant-based?
Right.
Plus, you still have ongoing restructuring costs, maybe some lingering legal issues, all signaling that operational stress. Long-term, everything hinges on turning consumer demand around and executing this complex product strategy successfully.
And what about the more speculative side? The traders not focused on fundamentals.
Oh, they're always watching a few things. Potential for another short squeeze is definitely one. That short interest is still relatively high.
So any positive surprise could set it off again.
Could do, yeah. Then there's always acquisition chatter. It's a known brand, market cap is depressed. Could a big food company see it as a cheap way into the sector? It's possible.
And the big one.
And the big one is that breakthrough innovation. If they actually launch something like that whole-cut mycelium steak and it's a hit, well, that changes the entire narrative overnight.
Okay, so lots to watch. How do we wrap this up then?
Final synthesis. The company successfully navigated a debt crisis, buying itself time and significantly improving its liquidity. But now it must prove it can execute a fundamental turnaround on the sales and margin front. The stock remains highly speculative, driven by external volatility rather than proven internal growth. The immediate question for investors is whether their cost discipline and new, simpler product strategy can stabilize sales before the cash burn becomes unsustainable again.